Some good news, some not so good news, but let's get into it. I think if we look at what has happened since the announcement of the IRA and China's reaction to that, and the fact that CATL and BYD are vertically integrated, we find ourselves in a situation where the markets can remain irrational for longer than some of the companies can remain solvent. Typically, one would expect, low prices to cure low prices, but we're not quite there yet. What are the issues around it? Well, inventories across the supply chain haven't fallen significantly over the year, and the production cuts that we've seen this year have been largely recently announced in Argentina, Africa, and Oz, and China. And we believe that another 100,000 tons needs to come off out of supply in 2025 to move prices up to 15,000. We have seen a move recently, but we think that to really get it to move up, we'll need 100,000. Bald Hill, probably about 14,000, 15,000, so another 85 to go. We'll discuss that. What is good? EV sales are on track this year to be above 17 million units. However, the US and Europe are below forecasts, and they largely have larger battery packs. And China and the rest of the world is ahead, but that's smaller packs and plug-in hybrids and extended range EVs using LFP. And China has, as an economy, pivoted again to looking to do exports to boost, and that means we've had overcapacity in a lot of sectors, and it also means that for the lithium supply chain. LFP cathode is lower qualification standards and intensity than NMC, and this has impacted our battery grade supply and demand dynamics. As I mentioned, vertical integration with BYD and CATL, it matters because independent mining and chemical processes are making low or no margins on an all-in sustaining cost basis. M&A activity, in the end, I guess that's what counts. What is the value of what's implied in the share prices? We've seen producing assets trading at below replacement, and we saw the Rio Arcadium deal. And excluding inventories, if we take those out, for us, on an all-in sustaining basis, we see spodumene concentrate as $1,200 for break-even, and we, as a reference point, trading in the low 800s. Chinese NEV retail sales have been phenomenal. You've got to remember that there's been, at the local and central government, those incentives to replace existing internal combustion engines with EVs. Those incentives can be as high as $2,800 from each of those, so as much as $5,600. So you can almost get a BYD seal for under $10,000, so a great incentive. And you've seen the parabolic move here towards year-end. The question is, how long will those incentives last? And is that causing any front loading into EV sales into this year? The other point to note is that plug-in hybrids and extended range EVs have seen a substantial growth year on year and are making up a larger portion of sales. Plug-ins were year on year 107% up in October 24, whereas pure electrics are much lower, and BYD last month 62% of sales were plug-in hybrid, and the year before that they were below 50%. So this has implications for the average battery pack size of EVs sold in China and the rest of the world. And if you're wondering whether it's a trend or not, NIO has now announced the launch of its first plug-in hybrid in 2026. So more to come. So what has happened to OEMs in China, the Western OEMs? They've seen a complete collapse. You've seen a turnaround from 2020 where they were 64%. They're now down to 36. I think in unit terms, that's a 6.4 million unit drop in that time frame. You can see on the right-hand side seismic changes of what's happened in sales. Why? Because they don't sell EVs. And China is now consistently above 50% EV penetration, way before forecasts. If you remember a few years ago, the target was 30% by 2030. We're seeing 50% in 2024. For OEMs, that's had a huge repercussion because they thought they could sell ICE vehicles for a lot longer to fund an unprofitable EV supply chain and do the pivot. And of course, that has now all changed. What about batteries? I'll skip through that, but looking at exports from China, again, a non-existent industry up until about 2020, and now we're seeing a huge export market. This is total autos, but EVs represent about 30%. This year they're looking at exporting 6 million units, so that's 1.8 million units. Again, huge repercussions for OEMs that are losing rest of world market share to China, that's exporting out EVs across the globe. What is at the heart of the problem here, and why are we seeing sales in electric vehicles in Europe and the US falling behind our forecasts? Well, part of the problem comes in what the offering is. It was easy when they went to the high value EVs to compete against ICE. The average price of an electric car in the US was $56,400 last month versus an average new car of $48,000, so at a premium. In Europe, it was $45,000 versus an estimate for this year of $28,000 for an average car. By comparison, the average price of a Chinese EV export is $19,000, so substantially below, and they are going to continue, even with tariffs, to take market share in Europe. Europe is pivoting. They are introducing low-end models, but they need to get it down substantially. In China, 65 to 70% of EVs sold are cheaper than their ICE comparative. That's not the case in Europe and the US. So I'm not sure. It's still undecided what a Republican clean sweep in the election is going to mean for the IRA and emission standards in the US. Are they going to go backwards? I'm not sure. But with Trump and Elon Musk buddying up, are we going to see an acceleration in the robo-taxi or full self-driving come through in the US? And how much of a game changer will that be for EVs if that's approved? We wait and see, but it will be encouraging certainly for the US, but I think there are going to be huge legal implications, and I'm not sure how insurance is going to work with driverless cars. These are the reality, these are the numbers. You can see Chinese EV sales, that's ahead of what we had as a forecast. Europe is actually down year on year to September, and that's Germany, largely, post-subsidies. And North America at 13% is below our forecasts. Looking back, in 2020, Europe sold more EVs than China. Fast forward 4 years, China's looking to do 11 million plus this year, and Europe 3.2. So that is a harsh reality to be faced. And as I mentioned, not sure on what the election impact's going to be for US and North America. So can Europe improve its EV penetration rates? Where's it going to go? They had a lot of legislation and pushing it, but now we're sort of seeing backpedaling. Next year's carbon emission adjustment should be helpful. However, European economies are weak, with rising deficit to GDP ratios, as you will have noticed. Will that mean that they will have an issue and a problem with allocating funding to promoting the EV green agenda. As far as EV tariffs on Chinese EVs, there was a split vote. Obviously, it has an impact for those countries that export to China, like Germany, looking to introduce tariffs to save what is an uncompetitive industry. But without, as I mentioned, without subsidies, EVs are still being produced at far too high a cost. And the concerning thing, I haven't shown the chart, but most of the pure EV players outside of Tesla, or all of them, are losing money. And we are looking at battery prices at an all-time low and lithium at very low prices. So it's unlikely to, other than scaling, for battery prices to drop materially, and therefore that is a concerning indicator. If you look at VW, they're talking about laying off and shutting plants. That's reflective of the whole continent's auto industry. And again, the question is, if you're losing sales in China and rest of world, how are you going to fund the EV transition and become competitive? I can't see that ending well as things stand. So where are we on for lithium? Well, it's been a harsh reality over the last while, with China really deploying resources globally. What you have to look at is, with China so much dominating EV sales more than expected, we've seen an increase in LFP usage. That means lower lithium intensity and lower kilowatt-hour average battery packs and lower cell production scrappage at the battery cell plants. So that has impacted on battery-grade net supply numbers. However, that said, I don't see a material oversupply, but I am seeing on the battery-grade side 50,000 and slightly higher in 2026. Again, my point, if you can get another 100,000 tons off the market, you can take that into a deficit and then also have the ability to eat into inventories that exist. So whilst it is, my forecast is for oversupply as a percentage of global production, not material, I think it can turn around, but these things are dynamic models. It comes down to price. I don't think the industry can sustain prolonged levels of lithium prices around the $10,000 to $12,000 a ton for that much longer, and I don't think you can also on spodumene at around the 800 and 850 level. But again, you know, one has to face reality, and absent of a demand shock and absent of more material coming offline, we don't see a supply issue until 2 to 2.5 million as demand, which would be in 2028. So we do need to see come off. We've seen Bald Hill come off. I personally think Mount Marion and Wodgina are two likely candidates. I know Albemarle has mentioned that, and that is a big producer. That could take the bulk of what you need to rebalance this market. This I took out of Pilbara's quarterly. It's benchmarks numbers, but they're not materially from mine, and it's a neater chart, so I've pinched it. If you look at their chart, they have, for the lithium cost curve, they have the break even for this year at around, I don't know, 15.5, 15.7. I'm not that high. I'm about 14.3. But it gives you a good sense of how much of the market is not making money at today's levels, and even moving it up. You know, we've seen it improve. It's climbing, but you really need to get it around that 14,000, 14.3 for people to be able to survive. The key is using up excess inventory. It is in the system. It's not overly material, but I would think there's 50 1,000 plus tons of excess inventory that needs to come out. And then the question that really needs to be answered as well, we know where a lot of projects talk about incentive pricing in order for them to be put into production. The question is, if we move back to kind of around these break-even levels, or the level that I'm looking at 14.3, is can spodumene projects in Brazil and Africa get funded below $1,200 a ton? I think there are some projects that can. So again, you know, are we going to see a mass wholesale price increase? I think that there can always be leads and lags, but I think there is more material being found. Just to rehash, I haven't changed the slide at all from last year. It's the same one on where I thought break even and prices. That's how I get to my number of 14.3. 1,200 on an all-in sustaining cost basis, I think, is where spodumene is at for most of the players along the cost curve that make up the marginal ton. You do the conversion and transport and so on, and there's your number of 14.3. So, you know, 10.5 just isn't going to cut it for a lot of the players. Goldman Sachs chart on the CME lithium hydroxide futures curve. What you can see is it continues and has always been in contango, pretty steep. The forward prices, even to the end of 26, are 40 to 50% above spot, so well above cost of carry. So the assumption is always some kind of recovery. I think prices now to N26 are around $14 or $15 a ton. So that ties in with the cost curve. We've seen open interest rise on the CME, which is encouraging. And if you look at the physically settled Guangzhou futures, the carbonate future in China, that's got greater volumes and open interest. That has a flatter forward price. To the end of 2025, you know, I think it's only about 4,000 renminbi above spot. So the discount has narrowed to the hydroxide future, but there's no big expectation of price rises going out, but there is more speculation that happens on that exchange. I mentioned earlier CATL and BYD, they're 53.1% of the global market. They are more vertically integrated than the South Korean producers, which means that they have their own in-house supply of lithium, and they have a greater influence in terms of buying power from the other producers. And, you know, for them, ultimately, in selling batteries, they can absorb a slight loss at the lithium stage as long as they're making profits at the battery cell stage. So is it in their interests to orchestrate lower prices in order to be able to buy up the rest of their needs at discounted prices from other producers? Yes, it is. Year to date, 23.4% for EVs growth in battery usage. It's above our forecast for the full year. However, the impact has been muted, as you've seen with lithium prices. So the question is, for me, is, you know, Chinese EV sales have had a huge boost. What if some of the incentives are withdrawn? What if there's a slowdown in penetration? Will the US and Europe be able to pick up the slack if they have got massive tariffs blocking EV imports? Certainly in the US, we'll see about Europe, because they are going to need to step up in order to keep demand growing. Other things to note, Northvolt and other operators have looked to, they're either struggling or looking to cancel or put on hold battery cell plants. Does that mean that CATL and BYD's market share goes even further? Do we see this phenomenon carrying on for even longer. One bright spot, something that I've been hugely bullish on, this is the IEA's chart and Bloomberg's on solar installations. You can see the markets have always underpredicted this. This year we're expecting more than 600 gigawatt hours in solar installations. That's expected to rise to a terawatt hour or more in 2030. It's definitely positive for silver in my opinion. And what's happening on the ESS is specialized production of cells. They're doing much bigger form factor, which has translated into lithium-ion batteries competing not just in the 0 to 4 hours battery storage, but pretty soon I think it's possible that they could compete up to 12 hours. So that's going to be a huge demand factor for lithium-ion. Sodium-ion will at some point compete. It doesn't do well at lithium prices this low, but if they can start to put scaled up production online, then that may be something to keep an eye out on. But we at RK are still 1 million tons LCE for lithium demand in 2030, and that is materially above people like Albemarle and others, and it can move the needle. We're probably above consensus, maybe 500,000 tons, and that, based on my supply-demand numbers, that has an impact. Broadly, the investment challenge for mining, this is mining.com, NVIDIA being bigger than pretty much that entire lithium mining universe, including all of the big mining houses. You know, you've got the boom and bust of mining, you know, versus a consistent boom that's happened in the Magnificent Seven. So attracting capital into mining has been challenging. Lithium, the same. And why? We haven't seen a lot in futures and in options to smooth out the price volatility. So in the last 10 years, lithium's been the best performer 4 times and the worst performer 4 times. Makes for long-term planning pretty tough. Will the growing lithium futures market, and now we have a CME spodumene concentrate contract up and running, will that smooth out price volatility? I hope so. That's likely to attract some volume. Hopefully it follows in iron ore's footsteps. When we did the interview with Fast Markets, the way it works on the spodumene concentrate and on the lithium contracts is you have the current year's contracts and then you have 2 years beyond. So come January, there'll be ability to hedge out 3 years if you can attract a counterparty. The big challenge facing ex-China battery supply chain is that China will accept low or no investment return and get massive government support, whilst ex-China, a lot of the time, projects need to stand up on their own and generate 15 to 20% IRRs. So there's a big bid offer on that. And depending on jurisdiction, you know, I know Western Australia is looking at it now, but they still continue to charge royalties even in these low price, in the low price scenario, and that's tough for operators. So a bit of an uneven landscape. So what does the investment thesis look like for lithium? We've seen 100,000 in production cuts, so I'd like to think we've seen the price bottom. But inventory levels and new projects coming online, I do think we need to see another 100,000 come off for upward movement. There is select value. We saw the Arcadium takeover by Rios because it was trading at substantially below its replacement value. Whether or not Rio is going to get its money back or generate a 15 to 20% IRR on the price they paid, I don't know. But there's definitely the odd pocket of value. Project by project, you always have to assess. And brines do have lower OPEX, But depending on where you are, sometimes there's provincial free carry and high corporate tax rate and capex in certain countries, which means that a DMS-only spodumene concentrate operation and a China chemical conversion, when you add those costs together, can have a better IRR and NPV on a greenfield basis. The other thing I think that's important, if we do see a price turnaround in lithium, is the extent to which short interest has climbed across the universe. This isn't the most recent, but I think it still goes up into end of September or October. But if you look there, it doesn't discriminate on jurisdiction. You've got most of the operating and some of the big players have seen short interest climb up to between 15 and 20%. That's a substantial number of days trading. So if we were to see a turnaround, a short-term turnaround in lithium for whatever reason, there's a lot of shorts that have got to get out. So that can cause a squeeze. So it's something to think about. And we saw that when the Arcadium bid was announced. Long-term fair value price for lithium. So I think you can't be in denial forever. One has to accept what we've seen in this last massive upswing in prices in 22. New resources have been found. Can one reasonably assume that new large resource projects will continue to be discovered worldwide? I think given that the lithium industry is immature, it's not a copper, it's not a silver. You know, new discoveries, I think, can be found, and it's possible that they can displace some second and third quartile operators now. So you have to factor that in. How much latent capacity is there? We know that there's quite a lot of brownfield backed up, and even with material coming off now with these cuts, how long does it take for them to come back online? I don't think it gives you enough of a window for a massive sustained rally. But against that, the question is, you know, China's total debt to GDP, if you add up central government, banks, and so on, and private, is well over 300%. So for how much longer can China provide generous subsidies, or will they? If that falters, that can change the landscape. But for us, my ex-VAT number for lithium is now around 18 to 20,000 a ton. You can add VAT onto that for the number, and that's down from 25 previously. I think there are projects in Brazil and Africa and elsewhere that can get up and running and feed Chinese converters that will displace some of the higher on the cost curve projects. So I have to take my medicine and lower that number. So what are the final conclusions? EV sales in China have been phenomenal. They are propping up demand, but the impact of that being almost exclusively LFP and plug-in hybrid with lower intensity and packs means that we have seen a change in battery grade demand and supply of that supply chain dynamic. US and Europe are behind forecasts. What will it mean in the US with Republicans having the House and Senate? And Europe, are they going to boost with lower price models and maybe Chinese manufacturers moving onto the continent, which will allow them to sell there? Energy storage for us remains a bright spot, and I do think that could surprise all on the upside. European and US OEMs losing market share. I think it's a very tough road for them ahead. I'm not sure how they're going to fix things. They need to see lower priced and competitive EVs come into the market. I think if that happens, it will improve. And then putting tariffs and blocking Chinese EV is definitely impacting demand because they do have the models to fill it. We don't see a supply issue until 2.5 million tons LCE unless something happens, but I do think there's room for the price to rise to $15,000 a ton with another 85,000 tons LCE after Bull Hill. If it comes offline, we can see the prices move. Thanks very much.